Good morning. I am Jay Kumar, Assistant Professor, Department of Management Studies. Now I am going to discuss about the topic bank finance for working capital management. So the bank finance for working capital refers to short-term funds provided by the banks to meet the day-to-day business needs. It helps firms manage expenses like purchase of raw materials, wages, and operating costs. The common forms includes cash credit, overdraft, and short-term loans. Banks access the firm's inventory, receivables, and turnover before sanctioning the limits. Interest is charged only on the amount utilized in most cases, like cash credit. It ensures smooth business operations and maintains the liquidity in the organization. So, um, the mind map of bank finance for working capital management centers on short-term funding support from the banks. The main branches include forms like cash credit, overdraft, and short-term loans. Another branch covers assessment factors such as inventory, receivables, and turnover. The cost aspects of your working bank finance for working capital includes interest rates, processing fees, and the repayment terms. The purpose branch highlights meeting daily expenses like wages, raw materials, and utilities. The outcome branch of the uh, mind map of bank finance for working capital includes liquidity, smooth operations, and better financial stability. So with this mind map, now we are going to discuss about the 5 forms of bank finance. Bank finance for working capital is provided in different forms to suit the business needs. Each and every business have different requirements, and based on the requirements, there are various forms of your bank finance. The credit allows the firms to withdraw money up to a sanction limit based on security. Bank overdraft permits withdrawal beyond the account balance, mainly for short-term needs. The short-term loans are lump sum funds given for a fixed period with regular repayments. Whereas the bills discounting enables the firms to get immediate cash by selling their receivables to the bank, and the letter of credit assures payment to the suppliers, improving business credibility. Each firm differs in the terms of flexibility, cost, and security requirements. These options help business maintain liquidity and ensure the smooth operations of the business. And the bank decides about the lending limits based on the borrower's creditworthiness and repayment capacity. They analyze financial statements like balance sheet, profit and loss accounts, and the cash flows. The working capital cycle, that is the inventory, receivables, and payables, is carefully evaluated. Banks also assess past transaction history and credit of a score of the borrower. Collateral or security offered like assets or inventory plays a key role. Industry risk and the economic conditions influence the lending decisions. Regulatory norms and internal bank policies uh, set exposure limits. Finally, the sanctioned amount ensures both borrower needs and bank safety are being balanced and met the requirements of the business. So I have given a case study of Tata about the bank finance as a working capital source. And now let us discuss about the 5 stages of design thinking which is being applied in working capital finance. Working capital finance can be understood using the 5 stages of design thinking. The empathize stage, which represents the bank, understand the business needs, cash flow issues, and operational challenges, whereas the define stage uh, represents the exact working capital gap and the financial problem are clearly identified. In ideate stage, different financing options like cash credit, overdraft, or bill discounting are being explored. In case of a prototype step, a suitable financing structure or loan plan is being designed for the business, whereas the test stage, the solution is implemented and monitored for the effectiveness in managing the liquidity of the firm. And the feedback is being collected to improve or modify the financing arrangement. This approach ensures flexible user-centric and efficient working capital solutions. So, to summarize, working capital finance refers to funds used to manage the firm's day-to-day operations. It ensures smooth functioning by covering the expenses like raw materials, wages, and utilities. Banks are the major providers through instruments like cash credit, overdraft, and loans. The amount is based on inventory, receivables, and overall business turnover. It helps maintain the liquidity and avoid the cash shortages in business cycles. The proper management reduces financial risk and improves the operational efficiency. Both cost and flexibility varies across different financing options. Overall, it plays a vital role in sustaining short-term financial health of the business. I'd like to thank everyone for giving me wonderful opportunity. Thank you.